Hello and welcome to this latest Market Insight. I'm Eric Parnell, Chief Market Strategist at Great Valley Advisor Group. And today we're going to talk about where we stand with the markets as we make our way through 2024. We got the S&P 500 trading at all-time highs with all eyes now looking at 5,000. But the stock market's at the high end of the range, and we continue to hear concerns about what's going to happen with the economy as we go through 2024, and is the Federal Reserve going to cut interest rates? Now, there's a bunch of good news to lead with. All these concerns about a slowing economy, we're seeing it on the fringes of the data, but the core data suggests that we have an economy that remains strong and corporations that make up that economy that are continuing to experience strong earnings growth. Yes, earnings growth has been revised lower by about 2% since the start of earnings season, but still we're looking at earnings growing at a near double-digit year-over-year rate, which is positive. Another factor that's worth looking at is some of the economic data. Now, we got a key release that came out the other day, the Federal Reserve Senior Loan Officer Opinion Survey, or the SLOOS data. And taking a look in that data gives us additional signs for encouragement about the economic outlook for the remainder of the year. Let's start with business lending. Now, banks have been tightening lending standards to businesses for the last year or so. But one of the positive developments we saw in the most recent report is that fewer banks are tightening lending standards. Things are trending in the right direction. So also take a look at commercial real estate. There was all kinds of concerns about the state of the commercial real estate market this time a year ago. But one of the things that we've been seeing from banks in recent months is that they have been cutting back on their tightening of lending standards to commercial real estate loans. The same is true on the residential mortgage side. We're seeing fewer banks tightening lending standards to those that want to go out and buy a home. And even the consumer themselves, if we're talking about credit cards or auto loans, banks are becoming less restrictive and more willing to lend money to consumers. All of these things are positive because from a graphical perspective, bank lending standards are coming down the other side of the mountain. And this is the type of thing that we see in the aftermath of recessions and when the economy is starting to accelerate. So this all leads us to a key point. There's so much concern about when and if the Federal Reserve is going to lower interest rates in 2024 and what that means for the markets. But maybe a different outcome is in store. Maybe the US economy is going to be stronger than we expect, and stock prices will rise because of the strength of the US economy, not because of the need of dependence for more liquidity from the US Federal Reserve. Thank you for joining me for this latest Market Insight, and I look forward to seeing you again soon.